Well, good morning, folks. Let's get started. Welcome, and thanks for joining us for day 2 of our financial institutions seminar. We have an agenda this morning. We're going to spend the next 2 hours together. We're going to talk about 2 sessions, and one thing we have a lot of is Jeff's, so don't worry about that. We got plenty of Jeff's. First hour is going to be myself. My name is Jeff Paley. I'm a partner here at the Bonadeo Group. I'm working with credit unions all over the state, across New York, and across numerous other states as well. We're going to talk about the top 10 strategic considerations for 2021, and we'll talk about what that means in just a minute. And then in our second hour, we're going to talk with Jeff Cardone, excuse me, a partner at Lutz Gorman, and he's going to talk about some, I would call them non-traditional acquisition opportunities and how those might be notable growth opportunities for credit unions, and we're seeing more and more of that in the industry. We have to start with a disclaimer, of course. The professional advice that we're about to give you and the topics that we're about to cover are not specific interpretations of a specific situation. So if you have anything going on at your credit union that looks like these things we're talking about, our advice certainly is relevant, but we'd want to talk to you specifically about the details if we were going to get into specific advice. So let's talk about strategy and planning for 2021. There's a lot going on. 2020 has been a most unusual year, and it's challenging to think about how to address all these things at the same time as we go into 2021. We're going to get into that in this session, and we're going to talk about the most common things that we're seeing credit unions talk about and some of the things that credit unions are doing in that context. A little bit about the Bonadeo Group, if you're not familiar with us. We serve credit unions across primarily in the Northeast, but also in other parts of the country. And we do a lot of the services that you would expect a CPA firm to do. I think we have a focus on the strategic elements, not just the technical accounting, debits, and credits stuff. I think you're going to see that in this session, because in this first hour, we're not going to talk about any debits and credits. So this is going to be good. As far as the terms of our engagement, we do like to set the terms of our engagement at the start of any time we're interacting with anyone. First of all, this is your time, it's not ours. So if you have questions can be challenging in this kind of a format. However, we do have the chat function. If you look on the right side of your screen, there is a chat function where you can send a message or a question to me or to any of the speakers that you're going to listen to today, and we'll address those questions as we go. Please feel free to put questions into the chat as we go. The other thing, when we're doing these virtual trainings, we know that multitasking is a thing, but we also know that you have a right. You have a right to give yourself a break on that and to focus on one thing at a time. So please think about that in the context of virtual training. I know everyone's used to virtual trainings by now. Keeping it casual and naming names, I tend to tell stories sometimes when I'm doing these presentations. I will not name names. And when you're typing your questions into the chat, you do not have to name names either. You can remain anonymous, and I will not be naming names as we go through the session today. And if you have any questions as we go, please, like I said, type them into the chat. So when we talked about putting this session together about strategy going into 2021, we sat down with our team of professionals who serve credit unions and banks, and we talked through, well, what would we talk about in terms of strategy? And in about 3 minutes, we came up with all these things. And we could have kept going, but we just kind of said that's enough. So we said, well, we have 60 minutes, so we're not going to talk about all these things. That's impossible. What should we focus our attention on? And we narrowed it down to 10 things. And we talk about turning the page to 2021. I think a lot of people are ready to turn the page on 2020 and move on from this most unusual year. We're going to focus on these 10 things. And when I say focus, when we're talking about 60 minutes and 10 topics, we don't have a ton of time to get into a huge level of detail on each of those topics. So what we're going to do instead is we're going to discuss them at a high level, and then we're going to pose 4 questions on each topic. Now, if you're keeping score, it sounds like I just said we're going to go through a checklist of 40 questions. That's not really how this is going to work. What we're going to do is talk about each of these topics at a high level. We're going to invite you then to think about 4 questions that are more specific related to each topic. And we invite you to think about those in the context of where your credit union is positioned on these things. My hope for you is that this serves as a confirmation that your credit union is already well positioned compared to the industry on these questions. I think it's possible, and I believe it will be likely that for each of you, you will see some things where maybe your credit union is not as well positioned as you could be, or maybe you need to sort of think about these a little bit differently in your credit union. And I view those as opportunities to start a conversation within your own credit union about some of these things, if you believe that you're not well positioned based on what we talked about this morning. So we hope this is meaningful. It's not it's not intended to be a checklist of 40 questions. That's not really what it is. It's supposed to provoke some thoughtful discussion within your own credit union about things where maybe you need to rethink your positioning. So we do have poll questions. If you want CPE credit, you have to answer the poll questions. And we have poll question number 1, which I'm going to launch right now. Does everyone see the poll question? It says, my credit union conducted a meaningful strategic discussion and articulated or updated a strategic plan in 2020, in 2019, in 2018, or I don't remember this in recent years. Please provide your answer there, and we'll give you about 30 seconds to get that question answered. And again, if you're a CPA and you want your continuing professional education credits, these poll questions are how we measure your participation. So if you want those credits, you have to answer the questions logistically. So we have almost everyone in. I'll give it about 10 more seconds. All right. We have spread everyone in. We have about half of the respondents talked about how they have done that sometime in 2020. They've talked about strategic plans and put together a strategic plan. Others, it was in 2019, and we have nobody who doesn't remember, so that's good. It's good that you have that knowledge of what your strategic plan is at your credit union. All right, so let's get into the top 10 things we're seeing people talk about. And number 1 is a little bit weird, and it's really unique to 2020. This is not something that's been on the top 10 list in many, many years, or I don't think ever that I recall. And it's the concept of changes versus emergency responses. If you're in a building that's on fire, you're going to respond to the emergency. You're not going to spend a lot of time articulating the business case for a particular course of action. You're basically going to respond to the emergency and act and do it. And that's what everyone else who works in that building wants to have happen too. Decide and do it in response to the emergency. Not a lot of debate, not a lot of building consensus, that kind of stuff. Am I going out the door? Am I going out the window? Not, am I going to think about this for a while? So credit unions did a lot of emergency response in the earlier part of 2020. What your level of response was and when you made these emergency decisions depends on where you are, because to some degree this was a state-by-state kind of thing, or even a locality-by-locality kind of thing. But we had a lot of credit unions who moved employees to working from home. We have a lot of credit unions who had branch lobbies closed. There were a lot of technological changes related to interaction with members, as well as work from home arrangements. A lot of changes to loans that you wouldn't have otherwise done related to forbearance and relief. And then, of course, health screening and cleaning procedures. Your hand sanitizer budget, I'm sure, was much higher than you originally planned for 2020. More recently, and we really saw this starting in August across the industry, credit union leadership started sort of shifting their mind around, well, yeah, we did these emergency response things back in March or April or whenever it was in your location. We like some of these things. The conclusion by the end of the summer was maybe some of these things are kind of good and we want to keep the good stuff. And those things include flexible work schedules, which may include work from home arrangements, member adoption of electronic channels. If your member use of your app went from 20% to 60% of transactional activity, most credit unions view that as a really good thing, although there are some challenges with that increase in volume as well. And then reduce travel expenses. Almost everyone has a savings on their travel budget this year. And maybe you can rethink how you do training going forward because you don't need to travel all the time. So how is your credit union communicating about this idea that maybe some of these things that we did as an emergency response, we're going to convert now to an actual change, a go-forward change in how we operate? Sometimes people are not going to like this. And it includes people who really liked the emergency response. People, when things were getting kind of crazy there in the spring or in March, your people most likely liked and were comforted by the fact that management was making these decisions about how we were going to move forward. And it was a confidence-inspiring kind of thing, in a weird kind of way, among your people to know that management was decisive enough to do the things they needed to do to move the organization forward. Now that you fast forward 6 or 8 or 9 months, and people think about this like, wait a minute, we're going to do this forever now? Or this is what we're really going to do going forward? People's attitude about the exact same thing can be totally different from what they viewed as a positive as an emergency response to they may view it as not as a positive when we're talking about it being a permanent change. And this is something that you can't, what we've found with organizations through the summer and into the fall here, if you assume that your people are just going to like everything that you're trying to do in terms of converting these emergency responses to changes, you may not be correct. And you can lose people, or you can lose people's enthusiasm for these things very quickly if it feels like you're making changes without input, without a process, and without proper communication. So we ask 4 questions, or we see organizations addressing these 4 questions about this process. And certainly there are other questions, but these are the 4 ones that we hear coming up most often. The first one is about consciously choosing which items you want to keep from these emergency responses. Some of these things might be happening unconsciously, but in that case, you kind of lose the ability to manage it. Are you consciously saying, I want to keep some of these work from home arrangements, and here's why, and here's the pros and cons? Number 2, are you controlling the messaging around this? If you're not trying to get in front of and understand the attitude of your people around some of these changes, you may be surprised at how negative those responses are. People are talking about these things, whether you're, as a management team, leading that discussion or not. So it's almost always going to be better to have management's leadership related to these discussions in terms of the overall approach and how they get executed. Number 3, are you articulating and measuring the pros and cons? You have, on some of these things, you have 9 months worth of data. You know what the adoption rate of your website usage by your members was before March and what it has been since the COVID disruption. And if it's markedly better, that's real data that you can use. And maybe you want to continue moving that forward. There's a lot of things like that credit unions generally think are good things that you want to keep going. And consciously deciding about those and measuring that is part of the process. And then this number 4 talks about this idea that we want to get back to how it was before, or maybe we don't. If your employees don't hear a message on this from senior management, they're going to make their own assumptions, and this can be stressful because it almost creates another layer of uncertainty. There's been a lot of uncertainty in 2020 as we've gone through all this disruption. The uncertainty of, are we going to get back to what it was like before this disruption, or are we going to adopt some of these changes as full-time permanent changes? That can be another stress point for your people. And we're seeing high-performing organizations address this proactively with their people. Again, food for thought for you. Hopefully, your credit union is doing some of these things. But if you're not, I think it's worth conversing about internally in terms of how you're moving forward on some of this stuff. Oh, we have poll question number 2. Let me see if I can get that up. Poll 2. Okay, question number 2. My credit union adjusted its normal allowance for loan loss calculation for qualitative factors associated with the COVID-19 disruption in 2020. True or false? We have, if you're not an accountant and you're not necessarily familiar with the allowance for loan loss, that's fine. Take your best guess. This is as close to a debit and credit kind of topic as we're going to have in today's session. So it'll get less debit and credit-y as we go forward here. We have a few more people coming in. I'll give it a few more seconds. Again, if you're a CPA and you want the credit, you have to respond to the polls. Give it about 5 more seconds. All right, so 100% said true, which is good. So 100% of you who responded indicated that you have added a factor to your allowance related to the COVID-19 uncertainties. Topic number 2 is lending and the allowance. And we need to acknowledge, and I think everyone knows, nothing should be a surprise here, you've done some stuff that you did not plan on doing with your loan portfolio in 2020. Every lender has. All this forbearance and payment relief programs. If you issued PPP loans, that's a newly created thing in March that has created quite a stir and incurred a lot of time of lending folks to figure out and execute. Also, there's been significant mortgage volume, including a lot of refi volume, because rates are in that range where that happens. And then changes to credit reporting, and also a lot of lenders being very lenient on fees, including late fees. All of these things are changes in 2020 that nobody really planned on as you were closing out 2019. So the major impacts, the number one thing is stress for lending people. Keeping up with all this stuff has been very challenging. There's no question about it. Regulatory concerns about credit risk and your members not being able to pay their loans. A lot of people believe this risk has been masked, if you will, by all the stimulus that came out in the spring and summer. And that only now, as that stimulus kind of runs out, are we going to start seeing some of this show up in delinquency data and things like that. There's a lot more need for communication with members. The loan servicing and collections process and just sort of loan management has been more involved in 2020 for sure. And then qualitative factors in the allowance. What we're seeing now, really, at least through 3 quarters where we have all the data for the 3rd quarter, there's been really almost no increase in delinquency, which is a little bit weird because you would expect, based on what's happened, that there would be. But again, it's believed, or it's theorized at least, that that's the impact of all this stimulus that the federal government has been dishing out earlier in the year. Many businesses have not returned to sustainable activity levels, but they're still paying the bills and paying your loan because they have this stimulus money that they got. And so it makes it very difficult to predict when you might actually have a problem on loans because you don't know exactly what the impact of that stimulus funds were. So 4 questions that we're seeing credit unions deal with and address related to lending and the allowance. One of them is, have you specifically considered the borrowers who took a forbearance or a payment relief plan as a risk category in the allowance? So even if those people took a forbearance period for a while during 2020, but now they're back on regular payments and they're okay, it's still believed that there's an elevated level of risk associated with those folks. And are you tracking that separately and accounting for it separately when you think about your allowance for loan loss? The other one is about these PPP loans. Most lenders made PPP loans to existing customers, to existing members. And the theory here is that those members who took a PPP loan, part of the reason they're still current on their other loans is that they got the PPP loan and they got that cash flow from that. So once the PPP loan money is gone, are they going to be able to pick up payments in a normal way without that stimulus funds? Have you considered industry-specific pools? And a lot of credit unions don't really break down their portfolio by industry. It's more of a bank thing, to be honest. But even if you're not doing business lending, if you know your member base is concentrated in specific industries, some industries were hit much more severely during this 2020 disruption period than others. So that includes things like airlines, hotel, restaurants, entertainment. If you have a member base that's concentrated in those areas, you really have to think about what that means for your allowance for loan loss and what that means for the risk of your loan portfolio. And you don't want to ignore that because auditors and regulators are going to be asking that question, and you want to really have an answer for that. And then the fourth one is, have you included a qualitative factor? We just did that survey, and you've all said yes. And this is really it's almost like a guilty until proven innocent. Like the assumption is you're going to need a qualitative factor. You're going to need some kind of incremental amount in your allowance right now because of everything that's been weird in 2020. If you don't have one, you need to justify that very clearly with some clear documentation. I think most lenders, in fact, do have a qualitative factor. So let's go to topic number 3, members. The members. Member behavior has changed in 2020, and it varies from credit union to credit union and region to region, but generally speaking, adoption of electronic channels has increased in 2020 at a pace that is significantly higher than it had been in recent years. Some people say this is an inevitable shift that was going to happen over the next 10 years, and it just kind of got concentrated into 2 months, March and April of 2020. But it's notable, and it's really significant at many credit unions. We've also experienced increased savings rates. Many credit unions are swimming in cash because members are depositing funds and loan volume is not keeping pace. There's also some smaller things like decreased use of currency, less use of branches, just less volume at the branches. And then the mortgage refi business has really been a big deal as we've gone through 2020 for those credit unions who are heavily into mortgages. The reaction of credit unions, there's been a move to hire more people and involve more resources in electronic channels. And that's the administration of the electronic channels, but it's also the monitoring of fraud on the electronic channels. Because fraud attempts come through some of these electronic channels differently than they come through other channels. And we're seeing a notable uptick in fraud cases, and hopefully you've allocated enough resources to keep up with that. Expanding electronic options. Credit unions who were kind of dragging their feet on being able to take loan applications through their website or some of those kind of things have found that they really need that to compete, and it's a challenge, especially for smaller credit unions. Reducing branch hours and really allocating people away from branches to other areas, and the biggest one there is a phone center kind of thing to be able to answer the phone more effectively. And then reevaluating investing activities. The interest rate environment is really bad, so if you have all these deposits coming in and you want to invest them, it's really challenging to find someplace that's getting you a decent yield without taking on too much risk. So the 4 questions about member behavior that we're seeing most commonly talked about and really kicked around at credit unions. The first one, have you identified member behavior changes that you want to continue? And are you acting proactively to promote that? Is there a sense that your management team or your staff just assume that, well, yeah, a lot more members are doing this, or they're using our app a lot more, and they're just going to keep doing that forever? Assuming that is a little bit dangerous. We don't know if people will keep doing this forever once things get back to normal in a post-COVID environment. So many credit unions are proactively trying to promote that, to keep it there if that's what they want. Again, this is about keeping the good stuff. Has the credit union right-sized resources, whether it's people resources or other resources? And a lot of that is shifting people to support these IT channels, these technology channels that members are using more. Have you identified services that you need to be added? I talked about being able to take loan apps on your website. This is a real challenge, especially for smaller credit unions. And the objective here is not to keep up with Chase and Bank of America. They have bells and whistles and resources that the typical community-based financial institution cannot do. But understanding that your members have things they might want and being responsive to that, even if you can't offer what Chase offers, is really the key here, and that's what credit unions are talking about. And are you actively soliciting feedback from your members? Members' needs are changing. There's a significant amount of uncertainty, and there's a lot of need on members in terms of what they're looking for from their financial institution, trusted advisor type stuff as opposed to products. So Are you responsive to that? Are you identifying that and responsive to that? Credit unions are doing this, and it's become a real topic of conversation. Number 4, employee engagement. Employees are people too. We got to talk about employees. So credit unions' relationship with employees has changed, and the 2 biggest changes are this work from home concept and the idea that you have people working remotely who may like it, and there may be benefits to doing this long term. It's not just an emergency response. The other thing is this idea that you're in your employee's personal business and you're actually treating people differently based on their personal situation. So if you have 2 employees who are in their 20s, and one of them lives with their elderly grandparents and the other one lives in an apartment by herself, you may be treating those people differently from an HR standpoint. Whereas before COVID, that would have been a big no-no. You wanted to give everyone the exact same treatment on everything. Now, you have to not only understand those people's personal situation, but you have to treat people different based on what their personal situation is. This is a weird spot from a human resources perspective, and managing that is sometimes challenging because you can get employees who feel that someone's getting an advantage because of their personal situation and not because of their job performance. This can be a challenge. The other thing is monitoring people's day-to-day activities and understanding that internal controls are in place. That's a challenge. And then you just can't get people together. So this sense of teamwork and esprit de corps is very challenging in this environment. So the key questions on employee engagement, again, this is what we're hearing credit unions talking about to try to address some of this. The first one is communication about changes and stress, and really just not necessarily even doing anything about the stress level that people are feeling, but just acknowledging that it's a real thing. And whether that's through your training programs, whether that's through a message from the CEO. I have one credit union client who's referred to every other week, the CEO does they call it a fireside chat. That's a really old reference if you've heard of fireside chat. But they do a recorded video message that they ask all the employees to watch every other week, just to sort of tell people that the CEO is thinking about them. It doesn't really deliver a major message other than we care about you kind of thing. Those are the kind of things that credit unions are doing to try to keep employees engaged, and really it helps drive retention and the whole teamwork kind of element of it. Have you identified and recognized employees who have thrived or employees who have struggled? Some people are not well suited. Their skill set is not well suited for this kind of environment. And there's a sense that credit unions don't want to part ways with these folks because they may have been a good employee for a long time before that, but the environment has changed, and sort of stretching that process out may not be the best thing. Credit unions are making some hard decisions on those things. They're also recognizing folks who are particularly responsive under the current environment, and they're differentiating between people in this regard in terms of promotions, compensation, et cetera, et cetera. Have you considered new employee onboarding? It's very hard to hire someone, train them, and get them totally integrated into your process when you have to socially distance everything. Almost everything you have to do in this regard is different, and credit unions are trying to react to that. And then, have you formalized policies around work from home arrangements or other flexible schedule type arrangements? Many credit unions didn't have any policies on work from home or flexible schedules before COVID. You instituted those as emergency responses when you needed to. If you're going to carry those things forward, you really have to update policies, and that can really protect the organization and the employees as you implement these long term. So again, things to think about. Internal audit and compliance. What more fun topic could there be than compliance? So credit unions with strong internal audit and compliance resources fare better. And part of that is because as you were making changes to your operating procedures, you had the internal audit resource to go to and say, what are the risks associated with doing this a different way in an emergency manner, with very short notice and almost no planning in advance? What are the risks, and how can we address those risks in the short term? And then how can we address those risks in the long term? Internal audit resources have facilitated a faster recovery, and we've seen this. This is, again, Unfortunately, I'm going to say it, bigger credit unions that have an internal audit resource in-house or have engaged an external internal audit resource in a meaningful way fared better on some of these things because you had that resource to go to for counsel and to just talk through what are some of the risks of what's going on right now and how do we address those in the short term. The smaller credit unions that may not have that kind of internal audit resource struggled a little bit with some of these things, a little bit more, I should say, with some of these things. It's not that they didn't get through it, they did, but it might have been a little more painful for the management team to execute some of these things and make sure that controls were in place throughout. So the key questions related to internal audit and compliance. Has your internal audit and compliance function adapted to some of these changes? If your internal audit function set out their plan, their audit plan for 2020 in the fall of 2019, and they haven't changed it at all as you've gone through 2020, that's not good. They have to adopt and adjust their approach. Has your internal audit and compliance plan been modified? It should be. If you rolled forward the old plan and you're doing the same old thing, you're definitely missing something. And you really need to give some careful thought to that as you go into 2021. Have you thought about the need for external resources? It's really hard to keep up with everything. We talked about the stress on your lending people, but there's stress on people in all the parts of your organization, including the internal audit and compliance folks. Do you have enough resources to manage through some of these changes and some of these sort of unusual things that are happening in 2020 and into 2021? If you don't, it can be worthwhile to bring in more resources, whether they're external or internal. And from a compliance standpoint, have your policies been updated? If you've dealt with the NCUA in an examination environment, you know that they love to understand that you're following your own policy. So some of the stuff you've done in 2020 may not necessarily be consistent with your existing written policies, and it's time to update those and or document the exceptions that you've made during 2020. The primary areas for this are employee stuff like work from home arrangements, and on the lending side where you were providing members with forbearance and relief. If all of that was outside your policy, there needs to be documentation around those things. Otherwise, when you get to your next exam, chances are you're going to get written up for doing a bunch of stuff that was outside your policy, even though you were doing it because of the COVID disruption and the CARES Act told you had to do it and all those things. Having some documentation is going to prove valuable when you get to your next exam. Business continuity. This is a kind of an interesting topic because it's come up a lot. As credit unions adjusted their processes in 2020 in response to this COVID disruption, they invoked their business continuity plan in some cases to say, you know, the business continuity plan is designed for we have a total loss of our administrative building and all of our servers, and how do we recover from a disaster like that? The COVID-19 disruption wasn't like that. You didn't lose a building, you didn't lose your IT resources or anything like that, but you did have to disrupt some of your operational activities. So some parts of your business continuity plan may have actually been enacted if you had people working remotely, for example. But really, the COVID-19 disruption was not a full real-life test of your business continuity plan because you didn't have to recover data. You didn't have to, excuse me, you didn't have to invoke the entire category of business continuity and disaster recovery plans. You had to take bits and pieces of it. And many credit unions learned from that experience that maybe they need to adjust or update their business continuity plans. It's made people think about their business continuity and disaster recovery plans. And some of the questions that are being asked are these four. The key questions: have you considered and documented the relevant lessons learned from the COVID-19 situation? Whether it was in March or some other time of the year where you had to make some changes, did you think about the processes that you had established in your disaster recovery and business continuity plan, or did you just kind of wing it? Not to say that either one's right or wrong, but if you have a plan for this kind of situation and then you just left it sitting there on the shelf and reacted outside of that plan to this disaster, does that mean that your plan isn't really that good if it's not useful to you when you have an emergency? Have you identified situations where you have too much reliance on the institutional knowledge of one person. So we see this especially in smaller credit unions. You have one person who's wearing multiple hats within the organization, and if that person is unavailable for some reason, and I mean, unfortunately, we're kind of ignoring the human toll of this COVID thing, but unfortunately, there were situations where that person actually had illness and was out of work for an extended period of time, or maybe they just were exposed in some way and had to sequester themselves for 2 weeks. Having that person unavailable proved to be a major burden for the organization and really presented risks in that that person is a key element of numerous processes throughout the organization. And when they're not available, that's a problem. So a lot of credit unions are thinking about, do they have adequate backups and cross-training for all their critical functions? If it's too much reliant on one person, that's a risk. And many credit unions faced that risk in 2020 because of everything that happened. Have you conducted a full test? Like I said, the COVID-19 reaction was not really a full test of your business continuity plan. It was bits and pieces for most credit unions, or maybe it wasn't anything related to your continuity plan. And doing a full test, this is kind of brought home to people, though, that an emergency situation can happen. You're not going to necessarily be able to predict it, and it's a real thing. Have we tested our plan if something else happens going forward? And then are you adequately considering the risks related to critical vendors? Every credit union relies on critical vendors for elements of their operation. Much of that is IT related, but it's not exclusively IT related. If you have those critical vendors, are you adequately thinking about the risks related to those? Many credit unions are, but some credit unions who thought they were, when they got to this disruption, found that the vendor was more vulnerable or presented more risk perhaps than they had originally thought. And there was some reevaluation of this and some rethinking of what does this risk evaluation of vendors really mean. Equity, inclusion, and diversity. And if you're joining the session and you can see my face, you're probably wondering if listening to a 50-year-old white guy talk about equity, inclusion, and diversity is really a wise thing. And you're right to ask that question. We're coming at this topic from the perspective of the things that we're hearing credit unions talking about. I do not have the answers on this particular topic, but we do know that credit unions are talking about it. And, that actually gets into poll question number 3. Let me pull up the poll question. Remember, if you're looking for the CPE credit for this as a CPA, you have to respond to the poll question. So poll question number 3, to my knowledge, a credit union has talked about equity, inclusion, and diversity at the following levels in 2020. Board level, senior management or management team. There's been communication to all personnel, communication to all personnel plus the broader community. Or I do not recall this being a topic at all. If you could answer, again, this is anonymous, no names. If you could answer honestly, we'll get the poll going. This is a hard topic to talk about, but right now, for the next couple of minutes, we're going to talk about what credit unions are really are trying to do with this, and some of the implications to strategic plans. I'll give you a couple more seconds here. All right. So we have the majority of folks said E. I do not recall any EID discussion. And we have a couple people who talked about senior management communications, but really nobody's talking about this on a broader sense in C or D. And that's pretty consistent with what we're seeing out in the community. So as far as this topic, I mean, there's a lot to talk about. There were people protesting in the streets earlier in 2020 about some of these kind of related issues. And there's been a lot of talk about it. It's been very difficult to know what to do. And I think that's the consensus position is, what do we actually do about this? Credit union people want to believe and that credit unions are much better on this than banks. The data that's available, and I will confess to you, we all have to acknowledge, I think, that the data on this is not complete. So the data is not exactly what you want it to be, but there is some data on equity, inclusion, and diversity in financial institutions. And the data that's available says that, yes, credit unions are a little bit better than this at banks, but not a lot better. Not as much, not better enough to warrant the kind of discussion that happens where the credit union is kind of putting them, the credit union industry kind of talks about how they're so good at this and that the banks are not good at it. The difference is really pretty small when you look at the available data. This is very challenging, but there is a growing sense that a wider discussion is going to happen. This isn't just going to go away. So now is a great time to move the discussion forward. It's hard to talk about. How do you start? Or the first question is, well, what do I do? And a lot of times that conversation goes something like this. If I'm going to reach out to folks to try to broaden my base in my membership, I can't simply just start making loans to people who don't meet the credit criteria. So when we talk about people who are economically disadvantaged, they probably don't have the credit score that would allow me to make a loan to them, or they don't have a financial situation that's such that I would want to open a checking account with that person. So how do I do anything without just violating all of my policies and putting the credit union's assets at risk? And those are all legitimate questions, and it's certainly something that needs to be talked through. And like I said, I don't have the answer, but those are legitimate questions. You can't simply just throw your policies out the window and say, I'm going to make loans to whoever walks in. But many credit unions are starting simply by thinking about the representation of and service to demographic groups based on these characteristics: male, female, age, race, economic means, and LGBTQ+. And just thinking about, do we have people in all these groups already represented on our board, in our management team, in our employee base, and in our membership? And does our membership match up more or less on these demographic categories with the community that we serve, or our potential member base, if you will? Is there something we can do to expand that? Oops, too far. So the key questions here, and there's a lot of questions here. Narrowing it down to 4 questions was really challenging, but credit unions are talking about this. Even if they're talking about it kind of quietly, there's discussions going on. And the first question is, can we talk about this? I mean, it sounds so basic, but really, like, can we talk about this? And how do we even start that conversation? So the first question is, have you started talking about it? And typically that starts at senior management and the board level. It's okay to not know where to start, but to just not start at all, generally speaking, is not considered to be the best path. So talking about it in some way, shape, or form is worthwhile. Number 2, have you thought about what kind of data you do have related to equity, inclusion, and diversity? There is data. It's not complete, but you do have some data, and understanding what data you have and what data you would like to have is part of starting on this topic. What data do I have? What data do I wish I had? And is it possible to get some better data than what I do have? Number 3, a lot of organizations, a lot of credit unions are bringing in someone external. So depending on what area you serve, what market you're in, there may be nonprofits who have been working in this area historically and have some kind of background information that's of value. This number 3 gets back to this idea that listening is the first step. And listening sounds like it's not actually doing anything because you're just listening. But it actually is doing something to say that you've engaged with other folks in the communities you serve to listen to the situation related to equity, inclusion, and diversity. If you can't listen and understand it better, then you won't know what to do next. So listening is a good place to start or to do in the early phases of this. And then as the credit union engage personnel at all levels, your people, your employees are thinking about this too. It's hard to get into this topic because in some circles, in some situations, this becomes a political type thing and nobody wants to deal with that at work. But you really have to eventually, at some point in your journey on this EID discussion, talk to your own people about this. And it's hard to predict where that's going to go exactly, but it's worthwhile to think about it as we move through 2020 and into 2021 there's a general sense that this topic is not going to go away, and that credit unions who choose to ignore it for now are going to be behind us later when it becomes more of a publicly talked about thing. Shifting gears, IT and cybersecurity. IT and cybersecurity risks have expanded. A lot of this relates to the fact that the bad actors who would try to steal your data are trying to take advantage of the disruption and the sort of weirdness of 2020, the changes to your typical processes, the fact that employees may have been in some disorienting kind of situations with work from home. They're trying to take advantage of this, and the most common attack types remain phishing attacks and ransomware. The bad actors count on the fact that your employees are likely to do something with their computer that they're not supposed to do, whether that's clicking on a link in an email, visiting a website that they were directed to through a phishing attack or something. This is a real thing, and the volume of this has increased. Smaller institutions are seen as softer targets. The Chases and Bank of Americas of the world have put in so many systems and layers of protection on this stuff that it's hard for the bad actors to get in there. They view a community-based credit union that's much smaller to be perhaps a softer target. And you may say, well, we're so much smaller, how much are they going to get? They can get enough to make it worth their while, and it's a real thing. So the key questions that credit unions are asking, and acknowledging that cybersecurity has been a big topic for a long time. It's not a COVID-specific thing, but the environment has changed because of COVID. So has the credit union effectively evaluated the adequacy of its cybersecurity efforts in the context of the COVID-19 disruption? If you set your cybersecurity risk assessment plan in the fall of 2019 for 2020 and you hadn't changed it at all during 2020, you probably are missing some stuff. And you need to definitely incorporate that into your 2021 plan if you haven't already. Is the employee training adequate in terms of frequency and subject matter? We ask this question of many, many credit unions, and a lot of them say, well, yeah, when we bring new people on, we do some kind of training about cybersecurity, and that's it. And somebody's been there for 5 years, and there's been no follow-up training, no additional training. Nobody wants to do training on this. It's painful, especially in a remote environment where you're doing it on a Zoom call or something like that. But you really have to keep reinforcing the risk to the organization and the responsibility of every employee to be smart about what they're doing with their computer. Do you understand cybersecurity risks of vendors? We talked about vendors before in terms of the overall risks. The cybersecurity risks are real as well. And understanding how your vendors fared through this weird year we just had of 2020 is important. And I think asking some pointed questions of your vendors about how things went down back in the spring when things got weird is worthwhile, and how they're going to be better prepared for the next disruption. And then has it expanded beyond the IT department? A lot of credit unions view this as an IT department thing, but really it should be more than that. It should be part of the HR department's plans. It should be part of whoever's doing training in your organization, and it should be part of really every department supervisory team's thought process as they're going through their day-to-day oversight of employees. Again, employees doing things you don't want them to do with their computer is the number one risk when it comes to, or the number one most common breach methodology that happens. We're up to number 9, your credit union's brand. We're talking about branding here. The first impression that your credit union makes has a lasting impact, and the way that you can make a first impression has changed in 2020. A lot of the first impression stuff was focused on branches, your website, and sort of word of mouth type stuff with members. Now, in 2020, when branches is not as much of a thing, or at least branch lobbies are not as much of a thing, do you have consistent and strong messaging through all these other platforms? Regardless of how the member finds your credit union or seeks out information on your credit union, and is that making you stand out? Is it effective? The key questions. One of the things I like to do for a credit union that I haven't, maybe I'm not familiar with, is I go to the website, and most credit unions have an About Us button on the website. I recently went to a credit union's website, and I clicked the About Us, and it talked about how they were founded in 1953, and they did some mergers over the years, et cetera, et cetera. But the latest piece of information there was from 2013, about a merger they did in 2013. If someone's looking for information about you, they're going to go to your website, and if they click the About Us, what does that tell that person about your credit union? I think the About Us part of the website is sometimes overlooked, but it's part of the mix in terms of how you brand yourself. So the key questions: has the credit union actively thought about what the credit union means to its members? It sounds like a weird question, and yes, I will acknowledge it's a weird question for a CPA to ask, but it's important because the bigger institutions have all these bells and whistles and services and products and delivery channels. You may not have all those things, but what does your credit union mean to your members? Excuse me. Is your value proposition primarily about transactions and products, or is it about service and an advisory trusted relationship? And how does your marketing and your branding tie into that? Are you communicating the value proposition to members and potential members across all these channels? There's a lot of noise. This could be your Facebook page. Is your Facebook page consistent with your website? Are you on other social media platforms that younger folks might be on? Facebook, I'm told by my kids, is for old people. And number 4, is branding consistent across the various platforms where your members and potential members may come across it? So we get into things like social media, texting, even your ATMs. Is there something there that's consistent from a messaging standpoint with all your other messaging that you're doing on all these other platforms? It can be really challenging to manage all the different channels and making sure they're consistent. But credit unions are thinking about this now because they know there's a lot more eyeballs on the electronic channels in 2020 than maybe there was before, and they have to accelerate their thought process of having a focus on those faster than maybe they had it in the past. Polling question number 4. Let's do polling question number 4. Let me pull that up. Open the poll. My credit union's attitude toward growth in 2020 is best described as grow. We're just trying to survive. We're growing, but wish we weren't. Sorry for the typo in there. Actively and effectively managing growth, or seeking additional growth opportunities. And there's a lot of folks, when we talk to the management team, they would answer C to this. And when we talk to the folks who are actually interacting with members and working directly in terms of your operations, say B, like we're growing, but it's really painful. So there's somewhat of a disconnect there. I'll give you about 5 more seconds on the poll because we're doing pretty good here. And we're doing good on time. Okay. So we have roughly half the folks answered C, actively and effectively growing, and about a quarter of folks answered we're growing, but wish it would slow down. And those are the 2 most common things that we see. Managing the growth is a challenge. So let's talk about growth. Very specifically, growth, there were challenges to growth before COVID. Those included non-traditional sources as well as traditional sources of financial services, fintech. Explaining what a credit union is after all these decades is still a thing. Challenging interest rate environment and keeping up with technology. Now, that was before. Now, in 2020, we have new things. We have reduced opportunity for face-to-face interaction. How do you deliver the message? We have the economic downturn and then the subsequent, depending on where you are and what your view on this is, the subsequent turnaround of the downturn, and then an even more challenging interest rate environment with interest rates being essentially zero or incredibly low. There is growth to be had, though, even with all these challenges. Mortgage volume, yes, it's a lot of refi activity. Loans for expenditures related to people being in their house a lot more. Home improvement loans and the like have been big at many credit unions. And then deposit-driven growth, which is both a blessing and a curse in some cases. But there are opportunities for growth. So the key questions that credit unions are asking about growth. Does your credit union leverage data in the pursuit of growth? There's this thought that data between artificial intelligence and data analysis and analytics, that there's value in the data that you have, and maybe there's data that you don't necessarily have, but you could have, maybe from credit reporting agencies, et cetera, that credit unions are trying to leverage to get more value out of their delivery channels, especially their electronic delivery channels. Have you revisited your approach to holding versus selling loans? Many credit unions have a policy where they don't hold 30-year fixed mortgages, they sell them. But with the interest rate environment the way it is and the expectation that it's going to stay extremely low for an extended period of time, there are credit unions revisiting that process and saying, maybe I do want to hold this 2.7% mortgage because I don't have anything else I can invest in to get 2.7%. And they're willing to take the risk on the duration of those loans because of the way the interest rate environment is. So credit unions are definitely rethinking that. Have you considered your risk tolerance for non-traditional acquisitions? In just a few minutes, we're going to have Jeff Cardone talking specifically about some of these non-traditional acquisition elements that are in the market right now and that more and more credit unions are seriously considering and actually executing. So we're going to hear about that as a specific opportunity. And then number 4, this idea that the equity, inclusion, and diversity activities could be a growth opportunity. There are underserved segments of the population in certain markets, or some would say in every market. Can you identify those and effectively call that a growth opportunity? And in the rate environment that we're in, that becomes, in some cases, a compelling path to take. So that's our growth discussion. Again, we just went through 10 key topics, and we talked through 4 questions on each of those. I'm going to check the chat again. I hope that this was useful to you. I hope that you confirmed that your credit union is well positioned on many of these topics. I also hope that maybe there are some ideas here that you can take back to your credit union and chat about internally that might be opportunities to improve your credit union's positioning on some of these things. Again, we had a lot of things. We're in a really interesting time. I think we talked through 10 of them. Certainly there are other things we could talk through, and I'm sure in your credit union there are other topics of discussion as you talk about strategy for 2021. We're always happy to chat through strategy with credit unions, and if you want a more descriptive or a more specific discussion of any of these and how they might impact your credit union, please, here's my contact information. I'm happy to chat with you anytime. Well, thanks, everybody. We're going to get started up again, and as promised at the outset, we have a full dose of Jeff's. I'm going to turn it over to Jeff Cardone, who's going to talk through like we had said, some non-traditional opportunities for growth through acquisitions and other items. I'm going to let Jeff introduce himself, and we'll go from there. Thanks, Jeff. Jeff, you're actually muted still.
Is that better?
Yes.
Pleasure, everyone. I'll do a quick, 30-second about me and Lou Squirman. So as Jeff introduced me, my name is Jeff Cardone, partner at Lou Squirman. Lou Squirman, we are a law firm that specializes in representing community-based financial institutions and credit unions. And the area we focus on in our representation of credit unions is really, corporate, regulatory matters, executive compensation, benefits, with an emphasis on transactions. And the 2 things we're going to touch on today are areas we've been working with credit unions, whether it's in the M&A space, credit union mergers, and credit union acquisition of bank assets, which those transactions have been becoming a little bit more prevalent in recent years, although in 2020, with M&A just being down generally, that's been impactful. But you're seeing more of that. And then I think the other piece, too, is the secondary capital piece. I know, hot button issue and my credit union clients talking about is, with all the, deposits and whatnot increasing, that's adversely impacted net worth And, so some credit unions are starting to think about, okay, ways, how can we, increase our capital, enhance our net worth outside of, traditional just retained earnings. So we'll talk a little bit about secondary capital if you're a low-income designated credit union and subordinated debt, the NCUA's proposed rules. In talking about buying bank assets, I kind of like to break it down, sort of the why these deals have been happening. And, to the extent that your organization is thinking about this, just very high level, what your credit union would really need to know about it. And to the extent you decide you want to do that or want to undertake this type of transaction, whether it's a whole bank acquisition or buying branches, the how piece of that, how would you consummate that, and so forth. So kind of kicking off the why. Credit unions, again, while obviously you don't have stockholder pressures and whatnot, you're a cooperative institution, certainly, the need for scale is in our space. It's, both from an operating, regulatory, compliance cost standpoint, to mitigate the low interest rate environment we're in, to try to enhance net worth. The number of credit unions has declined substantially over the last, 20 plus years. In addition to that, the NCUA has which has just been pending for a while, but it looks like it's going to take effect January 1st, 2022. So if for complex credit unions, so if you're over 500 million in assets, you're going to have new risk-based capital ratio. And again, this is to kind of streamline or make consistent some of the capital rules that apply to banks, apply to credit unions as well as a result of Dodd-Frank. And then you're also seeing a big issue, too, is from credit unions, from a strategic standpoint, obviously, you're limited from an organic growth standpoint due to field of membership restrictions, the member business lending rules, notwithstanding there's been a little bit easement on each of those. So, in addition to that kind of segue, thinking about buying banks, one of the big reasons is really for credit unions, you start thinking about, diversifying your loan and deposit products, diversifying your field of membership and so forth, is really to accelerate the expansion in those areas. And buying a bank can really enhance that. For example, I put on here the Federal Reserve Bank of St. Louis. They did an article about credit union acquisitions of banks. And what they found in their analysis of in looking at, recent deals, that, the average amount of business loans done by, relative to total loans was roughly 8.6% for credit unions. Compare that to the selling banks, and these banks are substantially smaller than the credit unions being acquired. It was at 33.8%. So you can see the disparity. Even though a lot of these selling banks were, thrift institutions that primarily did 1 to 4 family, a lot of consumer loans, a lot of synergies with credit unions, there was still a business loan piece that was more prevalent. And by doing a deal, you can really accelerate growth in those areas. And the same thing sort of apply with branch transactions, particularly, again, you're not buying the whole bank, but you may be able to acquire branches as banks are looking to sort of sell branches from cost-cutting reasons. And as part of that, you may be able to acquire loans or acquire talent as part of that. I think the other thing you're seeing for increased interest in banks, the number of viable credit union targets are declining. I talked to a lot of credit union boards, and they are really actively pursuing an M&A strategy. It's just hard to find a credit union that's really going to be a game changer in their market area, because a lot of times, credit union has safety and soundness issues. They may have field of membership runoffs. I'm currently working with a credit union right now. It's the process of selling, and the big reason is their heavy exposure to taxi loan medallions. So again, if you're that, even if you're not even a billion plus, you're saying, "Ooh, I'd like to find a nice credit union." They're just not there. And the other thing too is, if you're a healthy credit union, what's your real incentive to merge? Basically, then you're going to give the keys to your institution to somebody else. You're going to have lost roles and responsibilities in management, and there's really no deal consideration for it because there's no stockholders. There's nothing tangible, you're really getting for your institution. That's why you've been seeing sort of a decline in credit union targets, which is when leading bank or credit unions that are looking to be acquisitive to look at credit unions, or other banks. So here I say easier to acquire another bank. And when I mean easier, I don't mean the regulatory process or the transaction. What I mean by that is the social issue piece. Because obviously for credit union mergers, you have to have the social issues make or break a deal. You know, your board composition, who's going to be the management team, all those things. And so when you sit down and kind of try to hash that out, we've seen a lot of deals that, you know, at a very high level look great. They end up failing because you couldn't address the social issues. You contrast that to bank acquisitions. While social issues do play a part of that and culture and the like, obviously pricing and deal metrics is going to be first and foremost. So if you're offering the highest price for bank or bank assets, you're going to get the deal. So in that regard, it's easier because the social issues aren't number one. The other thing is, other advantage credit union has compared to banks is they have a stronger ability to pay than banks. You know, because of your structure, you don't have stockholders, you don't pay corporate taxes, you can take on, or pay more for a riskier target bank. You don't have to worry about, like banks who have shareholders, the more they pay, the more dilutive the deal is going to be to their shareholders. Credit unions don't have that problem, similar to mutual savings banks as well. I would say the culture alignment piece, there's a lot, as I said, there's a lot of synergies for particularly some of these smaller banks or thrifts who are selling to credit unions, culturally, from a cultural standpoint, with credit unions. And so in some instances, they prefer to sell to a credit union, notwithstanding what's, the banking associations who are obviously very aggressive and so forth with the credit union industry. In some instances, they liked the culture, the fact that even though we're selling to a credit union, a nonprofit entity. And I would say less execution risk. These deals have gotten done. And one of the poll questions will kind of address the number of that. But so success kind of begets success. And the fact that deals are happening, there is less execution risk, from the regulator's perspective, because these deals are happening. So that leads to the first, or poll question 5, the first poll question of my presentation.
The poll's up now, so please respond. Again, remember you have to respond to these if you want the CPE credits. What is your feeling about the regulatory climate for credit unions as a result of the election? We're optimistic about having a more favorable regulatory climate as a result of the election. The regulatory climate will likely be worse as a result of the election, but my institution will be okay if the Senate remains with the Republicans. Regulatory climate will remain the same regardless of the political climate. Or D, could be subject to federal income tax drastic changes to the credit union industry. We'll give you a few seconds here to weigh in on that one. About 5 more seconds. All right, I'm going to close the poll. So the most common or the most popular answer here was B. And then we have a pretty even split between A, C, and D on the rest of the responses.
So that's kind of a good segue. We talked about the why, and then, as far as the what. If you're thinking about this, again, this is sort of a very high level, just sort of some things to keep in mind when you're buying a bank assets versus, merging or acquiring another credit union. I think first and foremost, the structure is just different. And typically the way these deals are structured, if you're buying a bank or bank assets, is what's called a purchase and assumption transaction. So the credit union would be buying certain assets of the bank and assuming the liabilities, i.e. the deposits. It would not be a traditional merger of the bank into the credit union. And the reason for that is the rules don't allow for that. You can merge a credit union into a bank, you can merge a bank into a credit union, or you can't. For mutual savings banks, they would have to convert to a credit union first to do that. So that's why you have this structure where you can do it, where the assets just sort of get transferred in the liabilities, but there's not a direct merger. And then generally the considerations obviously all cash because credit unions don't have shareholders and can't offer stock as part of a deal. In terms of pricing, this is not a credit union issue per se, but banks who sell to credit unions are going to be subject to double taxation because what happens is because it's a P&A structure and not a stock transaction where you're paying for the shares or you're doing it as a merger. What happens then is the amount you pay for the bank is going to be taxed first at the corporate level, unless the bank's an S corp, which is probably not going to be the case. And then when the bank is liquidated and the money gets paid out to shareholders, it's going to be taxed a second time. So, and in contrast to that, bank-to-bank mergers, that's not the case. You're only paying tax at the shareholder level if there's cash involved, and if there's stock, there's generally no taxation until the shareholder ends up selling the acquirer's stock when he or she gets that. So as a result of that, while it's not impactful directly to the credit union, it does put the credit union at a disadvantage and should be considered if you're looking at, okay, I'm buying a bank, what do I want to pay for? You really got to factor in the double taxation piece. I think the target size bank, I would say expectations. If you look at the transactions of credit union buying banks, the general target bank is typically, for the most part vast majority below 400 million, but I'd say really the sweet spot has been in the $50 million to $250 million range. And the size of the credit union acquiring the bank has been substantially larger than that. And, again, the reason for that is because, again, it's all cash. So obviously the credit union has to have enough capital or net worth to do that. I also think it's helpful from a regulatory perspective in getting these deals done because the NCUA is probably going to be less concerning if there's a huge asset disparity between the credit union and the bank. If they're roughly the same size or the credit union is slightly larger, there's more safety and soundness risk to the insurance fund, and your deals tend to get more scrutinized. But generally, as I said, the size ratio is generally 5 to 15%. So again, if you were at a large credit union and you're like, I want to buy a large bank, billion plus, that's not going to be the market here. It's really these smaller institutions are kind of the sweet spot. Kind of building in the discussion we had about the taxes is, with the bidding process or buying a bank, again, you have to be mindful of the difference between the credit union bid and the bank bid. Now, if it's just a branch transaction, this is good. You're going to be on equal footing as a bank because the bank, when they buy, another branch, it's a purchase and assumption transaction. But for whole bank mergers, you're not on equal footing. And because of the double taxation and the fact that, the bank is going to incur other costs that may have to be netted against the amount that's paid out to shareholders, you have to kind of look at what's the net. The bank is going to, the shareholders are going to be looking at what's the net amount I'm going to receive, not, at the front end, what's the price that the credit union, so like an example here, I have credit union offers $30 million for a bank. Now the credit union thinking we're paying $30 million, but the bank would not necessarily view it that way depending on the impact of the double taxation and whatnot. They're going to look at what's the net amount our shareholders are going to receive. So let's say it's $24 million or $25 million, so then your price is less. And so when you're thinking about that and competing for other banks, when you're bidding on a bank, that's something to keep in mind. And that's why you kind of see credit unions, their pricing is higher. But again, when you factor in, this double taxation, the net amount, then it gets to be more equal footing as banks. If you're getting in the bank M&A space, you've got to realize too, again, this factors into your bid, is that a bank if it's going to sell, the deal is going to be shopped. And what I mean by that is what happens is there's this legal case law. It's called the Revlon duties. And what happens is for banks that have shareholders, if a bank is going to sell and they are going to get cash, they're not going to get stock. If they're going to get cash, that's deemed what's called a sale of control. And what the Delaware case law says, which a lot of states follow this, is that if you're going to sell your institution, you got to get that. You have a fiduciary duty to get the highest price reasonably available, which makes sense. So if a credit union's bidding $10 a share in cash and another bank's bidding $12 a share, if you were a shareholder of the selling bank, which bid are you going to choose? Obviously the $12 one. So that's something to be mindful of. So even if you found a bank in your local community, it's like, yeah, listen, we'd love to merge with you, or we want to be with you. The bank's saying all this stuff, that's great. They're going to have a fiduciary duty to reach out to other institutions just to build a record that they reached out and they were soliciting other bids, just to prevent in case they get sued if a deal gets announced. So again, that's also got to factor in terms of, the bid, because you're going to want to, if you really want the institution, you may want to bid a little bit higher. You don't want to let perfection get away from good with respect to a deal. And the one thing to keep in mind too is for bank deals, the driving metric for banks, shareholders on price, on the tangible book value of the institution and the multiple of that. So really it's almost like a multiple in layperson, your net worth. Are you paying, and it typically, pre-COVID, pricing was around the median was like 1.7 of tangible book value. For smaller institutions, probably more like 1.4, 1.5. COVID's a totally different animal now because of, compression of transactions. But that's the main, again, very high level deal metric that bank shareholders will look at and their advisors. Now, the positive or good news credit unions have is that you're member owned. So you don't have stockholders, you don't have stockholder pressures to deal with. You don't have to deal with any of that at banks. That's where you can more favorably compete if you're buying a bank, and you can pay a little bit more, unlike a stock bank who would then have to, if let's say they do a stock deal and it dilutes their shareholders, the shareholders aren't going to like that. Again, credit unions don't have that problem. But certainly the key performance metrics when you do a deal, one thing that certainly the NCOA is going to focus on is how dilutive would a deal be to your net worth from a capital perspective. And then you're going to look at, okay, can you make up that dilution with any earnings accretions, cost saves, and so forth that you're getting, retained earnings that you can get on a consolidated basis for the institution. So that's kind of something to kind of keep in mind just from a deal metric standpoint. Now, as I said, the one disadvantage, while that you've advantaged not having stockholders, big disadvantage for credit unions, and probably lesser so in this environment because I think a lot of banks like pricing certainty with cash, but obviously you don't have the ability to issue stock as part of the deal versus stock banks would have that ability. So depending on the selling bank and what they are looking for, that could be a disadvantage if they're looking to sort of get stock as part of the deal instead of cash. And where selling, where stockholders of bank may want stock would just be they're not looking at the sort of the short-term benefit or premium to selling. They're looking at the upside, the potential growth in the stock on a combined basis. So it's almost like they're reinvesting into the combined company. So again, and credit unions just don't have that luxury because obviously you're member owned, you don't have stockholders. This is a big deal issue. We've come across, with these transactions. The NCUA merger rules require that once you buy, you receive the deposits of the bank, they have to be immediately insured by the NCUA's insurance fund. It has to occur immediately at closing. Now, if you're a low-income designated institution, that would happen automatically. If you are not low income designated and you are a federally chartered credit union, it's a more of a cumbersome process. So, and basically you have to, one, ensure that the depositors are within your field of membership. And if they are, the depositors that are coming over from the bank have to affirmatively elect or approve to become a member of the credit union. So you can do that two ways under the duals. You can go out, just like any customer you're onboarding, get individual consent of the customers. You send out notices, have them fill it out, during the regulatory approval process, and you get consent that way. And then at closing, you can take the deposits. Or alternatively, you could actually have a depositor vote at the bank. The only problem with that, while the NCUA allows that, the banking regulators don't like that, particularly for stock banks. So really, the individual consent is really the key avenue. And then if you're state chartered or New York chartered, you'd be governed by New York, depending on how they would view this. And I'm not sure if there's been a New York chartered credit union that's acquired a bank that I'm aware of. It's really just been mostly, or at least when you're federally chartered. But certainly, I think in my conversations with DFS, I think they would be very favorable to this type of transaction, would work with the credit unions. But again, something to keep in mind if you're state chartered versus federal. And then, assuming loan relationships, because a lot of banks, for example, they do business with folks who are not depositors or members in the credit union world. So what you'd have to do then, if you're going to take on those loans, is make sure they have an account at the credit union at closing. You're also going to want to think about impermissible assets and activities of the target bank. For example, if the bank has a lot of commercial loans with maturities that exceed 15 years, which are not permissible for credit unions, or if the commercial loans you're going to take on are going to cause your institution to exceed your member business loan thresholds. The target bank may have municipal, and this comes a lot too, even in branch or more modest acquisitions of bank assets, branches, municipal deposits, broker deposits. So the question is, what are you going to do with that? How are you going to deal with that? How does that impact, the benefit of the bank institution? Now, I will say the good news is the NCUA with impermissible assets and activities generally gives credit unions a grace period to bring everything into compliance. And if it's not, for example, if you have a non-conforming loan, you can just sell it in the secondary market. And that leads to poll question 6.
Thanks. So we just launched the poll question. What is your institution's current capital situation? Sufficient capital through retained earnings? Sufficient capital but would need more capital to explore this kind of growth opportunity and investments in IT? Could use more capital for defensive capital planning purposes? And recently raised or received regulatory approval from the NCUA to raise capital. We'll give you a few more seconds to get in on this one. This has provoked a lot of thought, Jeff. People are definitely responding.
Great.
Few more seconds here.
Poll questions, forced attention to the audience.
So we have exactly. So we have a pretty even split here. Excuse me, with I'm sorry, with about a third of the folks responding to A, about a third B, and about a third C in terms of the responses.
Yeah. And we will talk about capital at the back half of the presentation. So now, just finishing up on M&A, or whether buying bank assets, both with whether it's more more measured branches versus a whole bank. This is just sort of the general life cycle of a bank acquisition. There's some synergies if you've done credit union mergers. There's the planning phase. due diligence, which is going to be, more of a process if you're looking at a bank, particularly a whole bank, than, another credit union. Negotiating, a definitive P&A agreement. And, in the credit union space, mergers, I know the NCUA has their, their merger docs. In some instances, we'll do a more formal, definitive agreement. And in some certain instances, it's just you fill out the form and that's it. If you're buying a bank or bank assets, you're going to have a formalized, P&A agreement. You're going to want one, to be honest with you. Then you got to think about the regulatory approval process, stockholder depositor approvals. Clearly as a buyer, NCUA approval is going to be needed. They're going to be involved, on the banking side, for branch acquisitions. The FDIC will be involved regardless because the depositors that you're going to be taking on are going to lose FDIC insurance. Depending on the bank's charter, if they're going to, have to dissolve, that's going to involve the regulators as well. So there's more regulatory hurdles with this than obviously if a bank was selling to another bank, and then obviously closing the transaction and integration and touching on some of the things we talked about before. So just very high level in the how phase. You want to, and this is sort of just reiterating a bit more from before. Don't let, if you're talking to a bank, it's going to be hard to find that perfect deal. And maybe don't necessarily let perfection get in the way of good. Because perfect just may not be available to a credit union for other banks, particularly whole banks. You may have perfect for, branch acquisitions and whatnot. And I think it's important to be sensitive and understand, for the reasons we talked about earlier, that you may have to pay more to, acquire a bank, again, because it's a P&A deal, you have double taxation we talked about. So then you want to just make sure the net amount that the shareholders are getting is competitive. And the other thing is, again, if you do a deal, success could lead to further success. Because a lot of times if a credit union does a transaction, even in a branch or a bank, whole bank deal, more deals will be brought to your institution, just from investment bankers, and you'll just will be known as an acquirer and somebody that can get a deal done, and that would make you more attractive to other institutions. I think having a general understanding of the solicitation process is important. Again, this is very high level. There's really two types, the informal or the formal. So the informal, and this is probably the most common amongst banks, probably less so for credit unions, but typically, like if you found a bank or you had a friend or a colleague in your market area, you start having informal discussions with that institution. And that could lead to, okay, this may make sense. Let's talk about pricing. Let's talk about social issues and whatnot. And I would call that the informal process. And you'd be surprised how that leads to deals, whether it's whole bank or branches. So like if you had a bank where you're like, oh boy, I love these branches, maybe worth calling that institution, saying, hey, any interest? Or if there are for sale, we'd love to have a conversation. So you're sort of trying to create a transaction. Conversely to that, you have the formal process, and this is where credit unions do get into the game. This is where a bank says, I want to sell these branches. I want to sell ourselves completely. They hire an investment banker, which is really, think of an investment banker as like a real estate broker for these types of deals. And so they will go out and actually call, 20 institutions or whoever's a viable candidate, let them know that they're for sale. They'll give them what's called a solicitation book. It's really a puff piece about the bank or their branches, the size and their performance and all these different things. And so that's the formal process. And then there'll be a bidding where you'll get it. If you get a book, you'll have the right to bid on it and submit a bid with your price. And then it kind of gets, and then eventually a winner is selected, and then you kind of move forward. That's the formal process. So that's why it's important too. If you're thinking about it, and I help out a lot of credit unions in that regard because we have a lot of contacts with investment bankers and advisors is just getting on that list just to make sure that if something comes to light, you want it passed along to your organization. And again, you don't have to do anything with it, but at least you may have opportunities that you could explore. Due diligence, in any deal is paramount. It's going to obviously have great importance if you're buying a bank or bank assets. And typically what happens is if you have a viable opportunity, you'll sign what's called a formal term sheet or letter of intent, which will govern the high-level terms of the deal. And it's not binding at that point. You have to have an actual agreement itself. But then usually what you'll put in there is you're going to want an exclusivity period. So in other words, once you have an agreement that you're going to okay, let's move forward, let's try to make this work, the bank's not going to go out and can't sell itself to others and reach out. They're committed to work with you or your institution to do the credit union, to do the deal. And then during that time is where you're going to really have an opportunity at a very detailed level, look under the hood of the institution, looking at their loan portfolio, asset quality, get a better understanding of any regulatory issues, look at minutes of the boards. You'll do management interviews. You can ask questions about their reports of exam, things like that. Look at any deal costs, vendor agreements, termination fees. And it's just, and because it's not a merger and the bank is being liquidated, these sort of deal costs are going to factor in, your pricing and whatnot. Obviously, you have an understanding of the regulatory approval process. Talked on this before, but the NCUA is going to require approval. You could have DFS depending on your charter. At the bank level, there's going to be a pretty cumbersome approval process. They're going to have, the primary regulator of the bank, whether it's New York or the OCC or the FDIC are going to have jurisdiction to approve it because you're liquidating the bank. Because the depositors losing insurance, the FDIC is going to be involved. The bank has a holding company. The Federal Reserve would be involved. And again, we've been through this numerous times with these regulators, and it's gotten done. But this is, again, just to show you the approval process. The bank stockholders are going to have to approve the deal as well. And then, the depositors are going to have to formally elect to become members. So we talked about, particularly if you're not a low-income designated credit union. But that all being said, I know it's quite the process, and I guess the goal of that was just to kind of introduce sort of a high-level, buying bank assets. But I will say, and I've done a substantial number of, strategic planning sessions for credit unions. And if you're thinking about growth and you're thinking about being acquisitive, I kind of view it as maximizing the tools in your tool chest. I think exploring banks, particularly branches. We've done a substantial number of credit union acquisition of branches and even whole bank acquisition. I mean, that should be part of your strategic plan. I think there's going to be opportunities. I think smaller banks are going to look for more viable acquirers, and I think credit unions, and that's sort of lacking. It's the banking industry. Banks are growing and growing, and they're not going to, that $100 million bank is not going to be as attractive. I think that's where really credit unions can fill the gap. And I think just key, if you're undertaking this, is just to have, the right advisors in place, people that have, again, whether it's us on the legal side or others, just, who have an understanding of not only the credit union side, but certainly the banking side. You can start having conversations with investment advisors, and we know a ton who can help you find deals, so et cetera. So that could really help from an execution standpoint as well. Now we're on to poll 7.
Thanks. So poll question 7 is launched. It says, how many bank acquisitions were made by credit unions since January 1, 2019, according to S&P Global? 20, 4, 76, or 13? Jeff, while we're having people respond, there was one question posed from the group, and it asks, if a credit union is going to acquire a bank, does it require the approval of the credit union's members? Do they have to do a vote of the credit union's members?
It's a great question, and the answer to that is no. The members would not have they don't vote on the transaction. It would only be on the banking side, where you have like a shareholder vote, or you may do the depositor vote, as we talked about, just to memorize them. But no. So that's one less hurdle you'd have to overcome. But that is a good question.
All right, I'm going to close the poll. Looks like we have B and D, pretty much a split between B and D is the most popular answers there, Doug.
I'll tell you, the answer to that is it's actually A, 20. Which I think I suspect it's probably higher. S&P Global tracks all depository institution transactions in the United States and throughout the world, and so they're a great source, and they had 20, but I suspect it's probably slightly higher than that because probably some deals didn't quite get tracked. But yeah, no, it's, as you can see, it's definitely picking up from when we did the first credit union acquisition of a bank back in, I think, 2012. It was at a very low level, and it's gone up pretty steadily, and I would expect that to continue. So. Just to kind of wrap up the presentation, the second half, I'm going to talk a little bit about capital and what's on the hopper with the NCUA. I talked about this earlier. The risk-based capital rules are proposed to take effect January 1st, 2022. This would apply to complex credit unions who are above $500 million in assets. And basically, the whole premise of this is just to sort of, because again, taking a step back, one of the big failures of the financial crisis, at least from a capital perspective, is the banks, particularly the large banks, were undercapitalized. And what the regulators found, whether you agree with it or not, is that the way they were, there was not a way to sort of assess riskier assets in the balance sheet and ensuring that there's a requisite amount of capital to support that. And so with Basel III, and this has sort of been, this concept of risk weighting is in the banking world, but this will sort of be new to credit unions. And really the premise of this is you're not looking at your denominator for your capital is not sort of on an absolute basis. Unlike when you're looking at your net worth, you're going to actually risk weight your types of assets that you have on your balance sheet. So, for example, more riskier loans may not necessarily be dollar for dollar in the denominator. You may have, it may be, 1.5 times, as a multiple, or 150%, or it can go as high as 1,250. And so what that would mean is then, as your numerator is how much capital you have, has to then support the amount of assets you have that are riskier. So again, this is a concept that applies to the banks, and then this was just designed by the NCUA just to sort of keep things, consistent and to take that into account. When this first came out, there was a lot of pushback. I know this has been delayed. I know the threshold went from 100 million to 500 million. Which I think was a smart move because typically the smaller institutions aren't engaged in as risky behavior as the larger institutions. So this is on the hopper. And as I said before, you're going to look at the numerator is going to be basically your institution's retained earnings, your allowance, the secondary capital if you did it, if you're low income designated, that will count. If you do sub-debt, and I'll talk about this, it will not. And I'm sorry, no, it will for risk-based. It won't for net worth. And then the denominator is your risk-weighted assets. I talked about it can range from 0%. Obviously, cash would probably be 0 versus more riskier stuff on your balance sheet is going to have a higher percentage. I'm sorry, I think I went the wrong way. And in addition to that, this is now going to be embedded in the credit union's prompt corrective action framework. As you can see here, in this slide, your net worth ratios to be well capitalized, you have to have 7% or greater. If you're complex, you're going to have, a 10% or greater risk-based capital ratio as well. So that's now part of that, your calculations starting 1/1/2022. Secondary capital. In the age of COVID and sort of the, particularly, credit unions, their increased worry about capital adequacy, secondary capital has gotten a lot more attention with our clients. And the way the current rules work is you have to be low income designated to access secondary capital. And really what secondary capital is in layperson's terms, it's just really a series of borrowings that the credit union can make from other, non-natural person, members or non-members. And I'll tell you, the typical investor is going to be other credit unions for this in the deals that we've done or we've seen. And again, the benefit to that is it's accretive to your net worth. And then there's just a few requirements to get the favorable regulatory treatment outlined here. Obviously, it's an uninsured non-share account. It has to be subordinate to all their claims to the credit union. And really, it's not so much an offensive play. It's really designed so that if you're low income designated, you can cover your operating losses with the secondary capital account. You have to have a minimum of a 5-year term to the investor, so you can't really redeem it for at least 5 years. And then it declines 20% per year in terms of your net worth calculation during the last 5 years until maturity. And the other thing, the piece of this is you have to get approval from the NCUA. So what I've been advising credit unions, particularly if they're low income designated, just again to maximize the tools in the tool chest, if this is something of interest, it may be worth, getting that approval from the NCUA. So that way there, that to the extent that you want to access the secondary capital market, you'd have the ability to do that. And the big thing the NCUA is going to look at is how much secondary capital you would want to raise. So again, you can go lower, but you got to disclose, at the most, what's the aggregate amount you're going to do? What's the purpose? How are you going to use the secondary capital? And a lot of that's just going to be to just augment your net worth and your capital. So I think it's a good story to tell the NCUA, and you're going to have to provide pro forma information. Now, if for those of you who are not familiar, outside of secondary capital, and this was a bit controversial. To be honest with you, I'm surprised the NCUA did this, just because you're going to get a lot of pushback, from the banking world, because now you're kind of really, because the big criticism or pushback, for why credit unions don't pay taxes and why banks pay taxes is banks, even if they're in mutual form, have access to capital markets that credit unions don't, and that's entirely true. And here, we're sort of creating a mechanism for more credit unions to access capital markets. So the subdebt proposed rule is really just an expansion of the secondary capitals. So if you're low income designated, it's all going to fall under this subordinated debt. If you're complex, and even if you're not low income designated, you can access the subordinated debt capital or supplemental capital, as they call it. And again, the NCUA did this because of the new risk weighting capital rules I just talked about before. And again, just to help credit unions have the ability to raise capital, and to the extent they need it outside of retained earnings. And as again, just like I said before, subdebt is just a fancy phrase for a series of borrowings or loans that are being made to the credit union from other investors. And the loans are structured in a way similar to secondary capital to get favorable regulatory capital treatment. So that way, and the benefit to this is the subdebt you're issuing counts towards the numerator in determining if you satisfy the risk-based capital rules. It will not, unless you're low income designated, help with respect to net worth. I think that's kind of been the big drawback or criticism of the rules from the various credit union associations, is that piece of it. So again, general terms, it's very similar to secondary capital. Few differences which I've highlighted. Really, if you're critically undercapitalized, you can't do it. The maximum maturity period is 20 years, still need a minimum of 5. You're prohibited if you issue subdebt you can't be an investor of sub-debt or vice versa. And there's an exception if you acquire the sub-debt vis-a-vis a merger. So that's something to keep in mind. Banks can issue sub-debt and invest in it. Credit unions will not have that ability under the proposed rules. It's going to be a more formalized process with investors. You're going to have, certain disclosure requirements. There's limits on how much, if you're making the investment, and how much of your net worth can be invested in sub-debt if you're on the buy side, not on the credit union who's sort of issuing the sub-debt. And one benefit is the pool of investors has been expanded. So now you can issue to what's called accredited investors. And this is a term of art defined under the SEC rules for private placement stock offering deals. So your pool of who you could raise capital to has expanded. And accredited investor, that's a fancy legal term for just sophisticated investors. These are not mom and pop investors. These could be individuals. These could be funds. But they have enough net worth or that they don't need, for example, the types of disclosures and so forth that, a more mom and pop investor would need and whatnot. You're still going to need NCUA approval, similar to the secondary capital rules. There's going to be offering documents, which is for both, but generally it's going to be like a note purchase agreement and a subordinated debt note that you would issue if you were going to do this to the investors or the lenders who are lending you money to do this. As I said, it's really a series of borrowings. How these deals are priced, similar to secondary capital, it's what's the interest you're going to pay on the loan. And a lot of that depends on the market. Typically, credit unions tend to pay a little bit higher than banks because they're viewed as a riskier investment because your ability to tap into public markets is not the same as banks. And you're going to want to sort of understand use of proceeds, whether it's going to be a capital cushion, whether you're going to use it for offensive strategic, invest in technology, finance M&A growth. That's going to be part of the story you're going to tell both with the regulators and to potential investors. Nope, now we're in the polling question.
Thanks, Jeff. Polling question has been launched. It says, how many credit unions have reported secondary capital on their call reports as of September 30th, 2020? 74, 105, 16, or 3? And actually, Jeff, while people are responding to that, there was a question. It actually goes back to the acquisition topic. It talks about what are some aspects of acquiring a bank branch versus the whole bank? Can you articulate that?
Can you repeat that? I'm sorry. What are the...
It wants to sort of differentiate between acquiring a bank branch versus acquiring the whole bank.
Oh, yeah. I would say the biggest advantage on the credit union side, it will be generally the same regulatory approval process. You're going to have to go through the NCUA and the issue of memorizing customers depending on your charter or your low-income designated status. There's a lot of similarities there. Where the big benefit to the credit union, though, is it's a much less regulatory process on the banking side because the bank is only selling a piece of its business. So there's no, for example, from shareholders' perspective, shareholders aren't really involved in that because really you're just paying a premium on the deposits that's going to go directly to the bank. In addition, on the regulatory side, it's really just going to be, you'll have the regulators involved, but it's a much more streamlined process than a whole bank acquisition. And quite candidly, you probably have a better opportunity of getting a deal and looking at branches than whole bank, depending on the circumstances. So yeah, there are definitely big differences, and I would say ease of it. Probably, and then the only drawback would be maybe less of a game changer. Like if you're trying to get loans and talent, you may only be able to get core deposits, and you may not get the loan piece of that. Whereas if you did a whole bank, you're getting everything. So it all depends on what you want. But those are probably the big distinctions at a high level. I don't know if I quite answered the question, but.
Thank you. The poll question is closed, and the answers, quite frankly, Jeff, are all over the place. It's almost evenly split between the 4 responses.
The answer is C, 16. Although, again, I think that number is slightly higher because again, it's what's reported on S&P Global. But yeah, no, I mean, I think, as I said, very limited chatter on secondary capital, and now with everything going on with COVID, having a lot more discussions, and credit unions are really looking at this. Particularly, again, you have to be low income designated as of right now, but certainly, as I said, worth exploring as a means to sort of enhance your net worth. And I think that concludes the presentation. So my email's here, my contact information. I encourage folks, if you have any questions, looking for further information, please do not hesitate to reach out. Always happy to have conversations and assist and have strategic discussions if you want to have a more formalized conversation or just have sort of very informal discussions and whatnot. I'm available. So I really appreciate, and it's a pleasure. I can't thank the folks enough at Bonadio for the opportunity to speak and whatnot. We have a great working relationship with Bonadio, and they do a wonderful job servicing our mutual clients. So thanks. And Jeff, you did a great job emceeing, so appreciate it.
Oh, well, thanks so much for your time doing this and participating in our day here. And thanks to everyone on the line. We really appreciate your time, and we hope you got something out of this that's valuable. You can reach out to either Jeff. Just remember the name Jeff, and you'll find one of us if you have any questions about any of this. That's the end of our session. Thank you very much, and you'll hear from us separately about the CPE if you're interested in that. Thank you.